morning, everyone. My name is Alan Fernandez. I want to welcome you to today's webinar with Treasury Curve, one of our partners, and our is the CSAC Finance Corporation, stands for the California State Association of Counties. The Finance Corporation is the part of the state association that manages the business and member services of the organization. And we're really excited to have one of our partners present this morning about their innovative products and services. So today the format is, you'll have a couple panelists talking, and there'll be an opportunity for you to engage and ask questions. And to manage all of that, my colleague here at the Finance Corporation, Chase Brofman, is on the line, and he will sort of direct traffic. And so with that, I just want to once again thank you all for taking the time to learn about our partnership with Treasury Curve. And Chase, you can go ahead and take it from here and provide some introductions and get the webinar going. But thank you all for attending.
Yeah, thanks, Alan. So as Alan stated, we are going to be recording the webinar today. We also have the chat window open. So as you have questions, you can drop them in the chat window or in the question and answer. And so we're going to be monitoring that as we go along. Today, joining us, we have Nancy Jerez from Treasury Curve. We have Sue Hill and John Mosco from Federated. And so we have a great presentation for you today. We're going to give you some really good market insights from the professionals. Very excited, very thankful for the partnership that we have with Treasury Curve. And so Nancy, right over to you.
Wonderful. So thank you all for joining, as mentioned by Alan and Chase. We're going to go ahead and kick us off pretty quickly here. I'm going to turn it over to John to introduce the team that we have from Federated Hermes. We're going to be talking about managing your liquidity in a rising rate environment, as well as some of their new funds that they've launched in the ESG space. So with that, John, I'll go ahead and turn it over to you. And Chase, if you can give us the first slide.
Thank you, Nancy, and thank you, Chase. And Chase, I'm flattered. I think did you call us experts? Well, that's a dangerous topic, but we'll take the compliment and move on. Welcome everybody. My name is John Mosco. I am the National Sales Manager for our liquidity products here at Federated Hermes. For those of you who don't know who we are, Federated Hermes is a Pittsburgh, Pennsylvania-based investment manager. We manage over $600 billion in liquidity assets. And 3.5 years ago, we purchased Hermes Investment Managers. They're a London-based asset manager who specializes in investing through the lens of environmental, societal, and governance factors, ESG, which I think we're all aware of. And we've integrated part of that into our process as well, which we can discuss if we have the time. But we do have 25 minutes, so we're going to talk quick. Fortunately for me, I don't have to talk that much. And with me today is my colleague, Sue Hill. Sue is the Senior Vice President and lead portfolio manager of our government money market fund complex, which comprises roughly $240 billion in assets. I will spare her legacy in the industry, but just know that she's very, very experienced. So with that introduction, why don't we just start the conversation, Sue? So thank you again. Thank you, CSAC, and thank you, Treasury Curve. I failed to say that. So Sue, if we were here a year ago, and we're not, but if we were, the Fed funds rate would be 0 to 25 basis points, and we'd be talking about, God willing, a couple of Fed rate hikes in 2022. Fast forward to today, the funds rate as of last week sits at 3.75 to 4%. Chairman Powell has discussed that it's not over yet. And with that bounce pass, why don't you share with us from your seat how you feel about monetary policies so far, and where do you think we're headed?
Okay. Thanks, John. I'm happy to do that. Good afternoon, I guess maybe good morning, everybody. Thanks for having me here. It's really a pleasure. So yes, a year ago, we're looking at a zero rate environment and looking at a Fed that would likely be moving fairly modestly in 2023. And I have to say, I've spent a good deal of my seasoned career talking about very low rates or zero rates, and it's much easier to do it in an environment when rates are really quite so high. So we know the Fed's been tightening in leaps and bounds throughout the course of the year. They have almost 400 basis points under their belts. And more to come, as promised in last week's FOMC meeting. The market has adjusted fairly quickly throughout the course of this process. We've adjusted fairly quickly throughout the course of the tightening. It's tightening that I have not seen in my career, and I can't emphasize how really extraordinary the shift and the pace and the timing has been of these moves. As we sit today, based on what we learned from Chairman Powell last week, the Fed continues to have inflation in their sights and employment, the tight labor market conditions in their sights as well. They were disappointed a week ago, or acknowledged disappointment in the lack of progress that they've seen so far in this really massive monetary policy tightening effort. They would have expected that inflation would start to turn around and that they'd see progress in other ways. But they hinted fairly strongly at that meeting that it's coming close to the time for them to maybe step down in policy, and that these 75 basis points supersized hikes might come to an end fairly soon. I think we learned today, or at least got some pretty good indication today, that it's likely to happen at the next FOMC meeting in December. Today we had an inflation report, a CPI report that was below expectations, which was the first time in my memory in recent months. The market has taken it and run with it in terms of expectations that the Fed might slow or stop or pivot. I don't think any of that is true, and we've had Fed officials this afternoon kind of correcting the general market perception that the Fed's ready to stop. But I think it's a step down in December. I think it's a 75 basis point move. I think that's an appropriate step to take, and I think the more conservative path going forward is probably the way to go.
So, and that's, I guess, sort of good news, because getting whacked at 75 basis points every Fed meeting makes it a little more challenging to, both from a fund management perspective and for the folks on this call for purchasing direct securities. I think you've explained on numerous occasions over the last 9 months that you thought you were smart and maybe kind of dip your toe out in the duration standpoint, only to find out the next day or maybe even after lunch that you were already underwater. So it kind of makes it a little more challenging as you think about investing. But it kind of leads to the question, Sue, where, we talk about this, peak or terminal Fed funds rate, where, I think 5% is what's getting kicked around. I guess I have two questions in that regard. One, how do you feel about that? And two, from a sort of, for the folks on this call who are managing their day-to-day cash, is this something that really should matter to them? And, given the options they have, and Nancy's going to explain later, from bank deposits to a money market mutual fund.
Yeah, so I'll start with the first in terms of expectations. I'm going to go with a fairly boring consensus view from my standpoint. The market is hovering with futures contracts around a peak in Fed funds at some point in the first half of next year, around that 5% mark, and I think that's a 5-ish is a fairly reasonable place. Really a reasonable place to land. I do think, if I'm wrong, it's going to be that it's going to be higher than 5 rather than lower than 5. I don't think we've quite gotten to the point yet in my mindset where the Fed may be virtually done and not have to move to the point of market expectations. So 5-ish, reasonable level. Does it matter to me if it's 5 or 4? Should it matter to those listening if it's 5 or 5.25 or otherwise? It really hasn't mattered much to us throughout the course of the year, and even as we look over the next couple of months. because although we're getting clear signals from the Fed about a step down in rates, the demand for front end assets, securities that I could buy within my portfolio remains like really, really strong. So a defensive posture still seems in order, or at least largely defensive posture still seems in order. You're right, we've dipped our toes in from time to time. We've certainly regretted it from time to time, haven't made any big commitments, so no harm, no foul. And although we're close to the point where I think there might be value at the longer end of a curve, still not quite there. Sitting on the sidelines seems to be the best thing for us to do. It makes for a fund that adjusts really quickly to market rates and market changes, and I think makes it a pretty compelling choice.
Yeah, that's a good point, Sue. Thank you. Let's kind of stay with that theme for a second. I know that as these folks on this call, if they do from time to time look at the actual holdings, they'll see that part of your holdings are the Fed's reverse repo facility. It's big. So is it something that we can expect to get bigger? And is it as a tool for monetary policy now? It seems that it's become a tool for monetary policy. Is the Fed concerned about that?
So remind me if I don't go through all of your points as I give some background on the New York Fed reverse repo facility. Absolutely, we have a very large position with the New York Fed. The core position for structure for our government funds, government obligations fund, Treasury obligations fund is typically very barbelled in structure, very heavy upfront in repurchase agreements that are collateralized by Treasury securities or agency securities in addition to Treasuries for government obligations fund. And we have controls in place so how we approach repo and credit limits and all of that, and a lot of counterparties that in normal times we do a lot of business with on a daily basis. That hasn't been the case really for the past couple of months as rates have continued their march up. The New York Fed reverse repo facility, the access to that facility is largely money market funds. It was a facility created back in the aftermath of the first 2008 financial crisis, or first financial crisis. So in that 2013-2014 time period, as a tool to let the Fed or help the Fed manage where short-term interest rates, where their policy rate trades. It's gotten large use, since the introduction, but nowhere near what we've seen over the past year. The reason why it's so large is, a number of factors. One being kind of the obvious one is that the Fed has a lot of Treasury securities on its balance sheet. Its balance sheet expanded massively throughout the 2020 time period and into 2021, and maybe even as recent as early this year. So it's got an awful lot of Treasury securities on its balance sheet. So its capacity for that facility is really quite large. Each individual counterparty has a pretty high limit in terms of access. And the rate is a reasonable rate towards the lower end of the Fed funds balance or Fed funds target range. But because the demand for front-end assets for short-term treasuries, high-quality assets in the government space, the safe haven assets, has been so high, the demand has outstripped supply of Treasury securities. So in many cases, for those counterparties or those entities that don't have access to reverse repo facility, my dealer counterparts can get funded much more cheaply elsewhere. So my traditional repo position is rolled into the New York Fed reverse repo facility. I've got plenty of company in the money fund industry. There's a lot of people that have some fairly significant balances. And it's a natural byproduct of the process of the Fed managing its balance sheet and beginning the quantitative tightening process. Where we go from here, or is the Fed uncomfortable with it, and where do we go from here? I think the Fed is not at all uncomfortable with it. They almost said so explicitly in the minutes to the September FOMC meeting that yes, the facility is really quite large at $2 trillion. No, it's not surprising to them that it's at that point. It may even get bigger, but eventually the forces will come together: return of supply, investors moving, the Fed coming to the end of their tightening cycle, investors moving into other types of investments where that facility will naturally decline. If it doesn't, Fed's got plenty of ways to make the money leave. But I think it's in the best interest of financial market stability for now to keep it where it is.
Excellent. We're kind of at the midway point here, and I'll just stop for a second to see. I know we're all allowed to ask questions as we go through, but I'll just pause for a second to see what they've heard so far, if that generates a question or two. Give that a second.
Sure. Chase, did we have any questions at this point, or did we want to continue?
I think we're looking good. That's great information, and attendees, again, you can drop it in the question and answer or the chat. We're happy to answer those live, or of course, if you do have questions after the webinar, we will also address those. But carry on.
Thanks.
It's great.
Thanks. Appreciate it, Chase. So I think the other thing, we'll kind of keep going here. I'm sure everyone, if they read their financial papers, read about Treasury liquidity in the Treasury market. I'm sure they all, in addition to owning what hopefully will be a Federated Hermes money market mutual fund, may own Treasury bills or agency discount notes or agencies at all of GSEs. And when it comes time to either buy more or sell what they own, find that maybe the pricing isn't as aggressive as it maybe was this time last year. And we've seen articles on a regular basis about concern from the regulatory authorities about liquidity in the U.S. Treasury market, which is supposed to be the largest and most highly liquid market in the world. If you'd be kind enough to share your thoughts about how you feel about liquidity, and in fact, is it a concern, or should it be a concern to the people on this call?
Yeah, so it is one of the topics that I've probably spent over the past month or so the most time talking about, because it has hit kind of the popular press, and it triggers a lot of questions about should we be concerned about this. From a front end perspective, in the securities that I invest in the Treasury bill market, the money market eligible types of government securities, I'm not at all concerned about the level of liquidity or the transactions that I see in the marketplace. On days when there's a lot of volatility or market movement, there might be a little bit bigger bid-ask spread, but it's not something that truly alarms me in terms of the fundamental investments that exist in the cash products. Where there is considerable interest, if I want to phrase it that way, is more out the Treasury yield curve. And so we've been through the course of this year a period of massive macro uncertainty, a lot of investors not knowing what's happening, looking for safe haven investments, and parking a lot of money at the front end of the yield curve, and we're very grateful for that. But it's left the trading out the yield curve to be more volatile than it typically would be. So a lot of up and down days. Today is the perfect example where the long end is up in price by 2+ points on the inflation data from this morning, but exacerbated, I think, for sure, by some of the program trading or high frequency trading that participates in that marketplace. So the Fed is watchful, and regulators in general are watching the functioning of the Treasury market. It's not at all surprising that investors have not been interested in buying, taking on 10 years of duration at the yields that we've seen, and in the uncertainty that we've seen. They are studying closely the structure of the Treasury market. There is a joint effort underway to do that and to make changes to shore up the dealer distribution network of that market. But if things were to get messy, for whatever reason, the Fed has the tools actually already in place to provide liquidity to the market in terms of the standing repo facility that they put in place about a year or so ago. And it just stands ready to provide cash to dealers who may find themselves in stressful periods and needing liquidity. So it's a topic, and I'm not saying it's not a justified topic, because there is quite a bit of movement out the curve and discussion about it. I'm comfortable with what we hold, and I'm comfortable that regulators are focused properly on it.
That's excellent. Well, about 9 minutes left. So one more topic for me, Sue, and then I'm going to bounce it back to Nancy.
Sure.
Where's the value? Where's the value in the curve? And how you, I think you kind of hinted on this at the beginning of the talk, but how are you positioning yourself and your funds in this environment?
Yeah, so I'll tell you what we've done sort of quickly, so we don't run through too much time. But done, this year, rising rate environment, you want to make yourself as responsive to rate changes as you can. We've migrated into a much shorter duration stance. So we are in a handful of days in terms of maturities, maybe the teens on, for some products. I've got, again, plenty of company in the money market universe, hovered in terms of short maturity at the front end of the curve. It has not been a successful strategy to buy fixed rate paper. It hasn't been very appealing from our standpoint. We have found a lot of value in floaters throughout the year, whether it's Treasury bill-based floaters or SOFR-based floaters in the agency world, and I think that has helped to again position ourselves to mitigate market risk, but also respond fairly quickly. As I stand today, again, we're looking to see the point at which everybody extends, or we should buy, and we should take on that value. And I'm really just not quite there. I think the Fed has more to go. So the greatest value for me really is in that overnight position in the New York Fed in particular, or in addition at least.
That's great. Well, thank you, Sue. Well, look, let me finish where we started. We may have, if we have some time, we can talk a little bit more, but I want to thank, obviously, Sue, thank you for your time and your day. I want to thank the folks at CSAC for arranging this opportunity, and to Nancy at Treasury Curve for partnering with us. We really value the partnership with Treasury Curve. They're experienced, wonderful individuals. We love working with them. We're hopeful we can extend and grow this partnership, and anything we can do to make sure that the folks on this call are informed, please, work through Nancy and Chase, and let us be advocates for helping you manage what we think will continue to be probably a rockier before it gets smoother, if you will. So Sue, thank you. Nancy, I'm going to bounce it back to you.
Wonderful. Thank you, John. And I think what we want to hit on next, just specific to Federated Hermes, is the launch of the SDG share class. So really in the public entity space, we find very much an interest in investing in funds that give back to the community. So it's certainly in highlighting this fund. This is a fund that gives a percentage of the profits back to the Hispanic Heritage Foundation. So as we look at your objectives in investing, not only do you want to have a great fund that's managed conservatively, as Sue spoke about, you want to be able to get a great yield, have very sharp expenses where you can. You want to be able to give back to the communities, and then certainly you want to do it in a way that's efficient. So in partnership with Federated Hermes, you're sort of checking all of those boxes that you want to accomplish. And one way that we are really focused on helping the public sector and their investment processes is really doing a lot of benchmarking. So, as John and Sue mentioned, a year ago, rates were at zero, and that meant your money fund balances were close to zero, but as well, folks were keeping a lot in deposit, earning zero. And so where we're spending a lot of time and adding a lot of value is specific to benchmarking that we're doing. And Chase, if you can go ahead and take us to the next slide, that would be wonderful. And so as we look to benchmark where your liquidity is, we find in the public sector space a lot of funds sitting on deposit. So that could potentially be earning zero. And so certainly an opportunity, if you look at Federated Hermes, we're talking right in the about 3.6% ballpark as far as current yield. So a big pickup from zero. And then certainly within the ESG government space as a whole, there are some pretty sizable pickups as well. And, it could be, depending on what you might be invested in currently, it could be 30 bips, it could be 60 bips. And on the amounts that we're talking, these are sizable differences. So our call to action would be to reach out to us. We're happy to take a look at what you're currently utilizing as far as deposits or in funds, and help you benchmark to make sure that you are getting those optimal returns. And we certainly think that Federated Hermes is a great place, just given all the things that you're trying to achieve. Being conservative, number one, that focus on liquidity that Sue talked about. And the specific fund that is in the ESG space that is giving back to the Hispanic Heritage Foundation is one of the largest funds in the industry. You can see here over 132 billion. So very, very sizable. And then certainly AAA rated by S&P, Moody's, and Fitch. So all the things that you're going to be checking off on your list, that what you want to see specific to your investment policies. So in that effort, we're hoping to help you get better returns and meet all those investment objectives that you have, including giving back to the community. And then Chase, if we can take it to the last slide here. The other thing that you can do in helping your money work hard for you is that you do get access via the CSAC and Treasury Curve partnership. You do get access to our investment technology at no hard dollar cost. So makes it easy to be able to get your investments underway and then be able to access them very efficiently via the Treasury Curve technology. So with that, I will go ahead. I think we're just at a few minutes. If there are any questions, we're happy to take those at this time. And I'll turn it over to you, Chase, for any questions that we may have.
Sue, Nancy, appreciate you both. This was really great. And CSAC, here at CSAC, we really do appreciate the partnership with Treasury Curve and, the insights that your partners have and into the markets. And I think that really adds value to California counties and counties across the nation. And so we appreciate you for that. I don't see any questions coming in the chat and the Q&A. Sounds like you answered them all. That could be a good thing or a bad thing, but it sounds like a good thing. And so Sue, great job there. And attendees, again, we're going to follow up. Nancy and I will be in touch. And so if something comes to mind, we're more than happy to either answer that directly or get you in contact with the people who can. And so appreciate all of your time. Thank you for taking time out of your day, and we'll see you next time.
Thank you.
Thank you, Chase.
Have a great day.